Hello and welcome to the Fat-Tailed Thoughts podcast. I'm your host, as always, Stephen Dickens. This week we're going to be talking about market makers, and I'm joined by my co-host, as always, Jared Klee. Hey, Jared,
Stephen,
welcome
how
to
are
the
you?
show. Yeah, I'm good, man. How are you?
I'm good. I'm not quite as good as you. I didn't make any leaderboards this past week. Any chance you did?
Maybe. Apparently, according to some random list on the internet, I'm now the 90th most important person in a tiny group of people who cover the tech industry. So, time for my victory lap, I suppose.
They didn't ask my opinion. You would have been higher, I
Oh,
promise.
you're too kind. You're too kind. But no, you know, you put your work out there, and it's nice to see some recognition. So I had a decent week. Let's put it that way.
Well deserved. Congratulations, sir.
So, episode 14 of the show.
And for listeners, I will take full credit. Stephen introduced the last one as episode 12. I apparently don't know how to count. We'll just say 13.
You are fantastic at understanding the workings of these markets, but the basics of counting you struggle with.
Fully beyond me. This is last was 13. This is 14. I promise we'll figure out how to count one of these days.
We're just going to skip. We're going to have an excuse. Jared's not heard this. 13's an unlucky number in a lot of cultures. So we didn't have an episode 13.
We'll play this one back. So we're doing episode 14. Last week we skipped it. We did not want an unlucky episode.
Yeah, there you go. There you go.
Well, cutting room floor.
Yeah, we'll cut that bit out. So enough of the goofing around. Huge topic for us this week. The making of markets, the structures of exchanges. Great newsletter. Took me a while to go through and read it. So it's, listeners, if you've not read the newsletter, Jared suffers with the same affliction that he does when he speaks, when he writes. Being concise is a challenge for him. But no, all joking aside, fantastic newsletter, super detailed. Let's get the listeners orientated here. What are we covering today? I think it's two big themes, but just lay in some detail for us.
Stephen, markets are wildly powerful ideas, and I think we take them for granted because they're simply everywhere. A lot of the innovation that's happened over the years, the innovation that's still happening, again, we don't pay attention to because it's simply just there and it just works. Nonetheless, the ideas underneath that are extraordinarily powerful. So let's just start with the basics. Somebody wants to buy something, somebody wants to sell something. We need a mechanism where they can meet, where they can match, and where they can exchange. The kind of traditional, let's go way back, the traditional method is you got a storefront and maybe you have a market square, a town square where people meet. The challenge is that puts the constraint of time and space on the transaction. Both people have to be there at the same time. They have to agree on a price. They have to agree on how much of it they're going to buy. There a lot of stuff could go wrong. So we've evolved and actually invented something called an order book. And an order book is what it sounds like. It's just keeping track of, hey, I'd like to buy these, and hey, I'd like to sell these. And that's at the beating heart of how financial markets work. An exchange hosts a series of order books that match up buyers and sellers. And over the years, we've evolved a role called a market maker who does exactly what it sounds like. They're a middleman. They sit in between buyer and seller to make sure that even if they're not always there, or they might disagree on price, there's always somebody in the middle standing ready to buy and sell. The challenge is that market makers have some drawbacks. There are limitations to where and when they can operate. There are limitations to how order books can be effective. What we're starting to see an entirely new way of making markets called automated market makers. It's appearing in the crypto world, but it has applicability for a whole variety of markets, precisely those where kind of traditional market makers fall short. It's wildly exciting.
So, I mean, and we're talking about a relatively recent period of time. I've been to the New York Stock Exchange. I had a pleasure of having a tour down there. There's still physical market makers sitting kind of on the trading floor. But if you ask most people of their perception of what they think of, the stock exchange, it's lots of arms waving. People, maybe from the movies, they've created that image. It's not like that now, but we're talking maybe at 10, 15 years ago, that was what the market was. There was obviously big trading going on, and it was starting to get more automated. But, you know, I've met and spoken to the guy who was the market maker for IBM stock when I went down there. You know, these are still physical people. Now, yes, everything else is automated behind them, and they're a public face of that. But we're not talking about something that's, you know, decades old from an automation point of view. This is still relatively new.
Correct. So you had, until recently, until the electronification of markets and orders and the like in the late 90s, and then clearly accelerated since then, you had, even for your biggest markets, your biggest equity market stocks and your biggest, the IBMs, the Dow list, the massive companies, you still had a floor trader who would stand near the post. And exactly as the movies describe, if you've ever seen Trading Places, the people screaming and taking the pieces of paper and saying, I'll take it for this much and that much. And they're kind of really shorthand language. It's really exciting. Now, we moved on for that. I jokingly called the title of the letter Matchmakers versus eHarmony, because what we've seen happen is we've seen those floor traders manually making markets over time get replaced by high-frequency trading firms. Now, that is, again, you've got people under the covers behind the firm, but that's fully automated. I mean, we're talking trades where the average amount of time as a middleman that they're holding onto the stocks is measured maybe 100 milliseconds, maybe a few seconds at most, so largely automated. But again, that comes with drawbacks that we're going to dive into. The biggest of which, Stephen, that's a really effective way of making markets when there are a lot of trades going on. But when markets are small, say a public company that's only worth $20 million, the whole company, or if we go even further out, let's talk about a market for comic books or what you're into, watches. That's not that high frequency trading firm, that fully electronic, it's not a very effective mechanism. It simply can't be profitable in those markets. So we need another way.
So that's the interesting thing that comes out from the first part of the letter. This requirement for scale of the market that the market maker is operating in. I think we kind of think of the stock market as kind of one big amorphous thing, and there's trades happening, and you highlight one particular stock, and you were hinting at it there, that trades for a total market cap of 20 million. The volume of shares that are traded on a daily basis, there's not enough market to make, speaking about it simply, between the buyers and sellers, because the whole stock is not worth that big and there's not that many shares that trade. I think it's worthwhile spending, for you, 30 seconds, which translates obviously to a couple of minutes on that topic.
So let's level set. I called them middlemen, and I think it's worth extending that analogy for a sec, and then we can talk volumes. If, Stephen, let's say that we wanted to run an import-export business, what we'd be doing is we'd be buying, say, raw materials from abroad. Maybe we're buying bananas that are going to be sold in the store. Maybe we're buying iron or steel that's going to get manufactured in the U.S. We're going to act as middlemen. We're going to import that. We're going to store it in a warehouse somewhere, and then we're going to sell it to a buyer in the U.S. And maybe we take manufactured goods out of the U.S. and we sell them abroad. Again, we can be a middleman in that direction. In that model, our goal is not to bet on, say, the price of bananas going up, if that's what's in the warehouse. Our goal is to buy bananas cheaply abroad and to sell them at a slightly higher price here in the U.S. and capture that in between, called the spread, the difference between the price we bought and the price we sold. Market makers do exactly the same thing in the securities market, just at way bigger volume and way faster. So Jane Street is among the biggest market makers in the US. They are a high-frequency trading firm. In 2020, they did $17 trillion in transactions. 17 trillion. Now, again, the average holding time on this is fractions of a second, but that's an astonishing volume. Their revenue was only 1.5 billion. So even 1.5 billion is nothing to sneeze at here. But let's be clear, 1.5 billion in revenue on 17 trillion in transactions facilitated. We're talking less than 1/100th%. In the finance world, we talk about bips. A bip is 1/100th%. We're talking quite literally 9/10ths of a bip. This is teeny, teeny, teeny margins. What that means is when you run a business like that, you have to have markets where you can move $17 trillion worth of stuff in order to make meaningful revenue. So as we go down the curve to smaller and smaller and smaller markets, it simply isn't profitable for a Jane Street to step in and try and be that middleman. They're not set up to do that. They're really well set up for the big markets, and they're really not set up for the small markets. That has some pretty real consequences. If you go look at the cost of trading in financial markets, it's not linear, meaning it doesn't get linearly cheaper to trade shares in highly liquid big companies like Apple or Microsoft or the like. It is a stepwise function, meaning it's really cheap to trade the big stuff because folks like Jane Street are in there providing liquidity, that middleman solution where they're basically providing oil, and the difference between the buy and sell price is really small. As you get to the smaller markets, it's not like they're less market makers. There just aren't market makers. And it becomes order of magnitude more expensive to go trade, say, the small cap company, something worth $20 or $50 million. That's a real burden for those small companies if they need to make sure people can buy and people can sell. Up until recently, we simply didn't have an effective mechanism.
So I think that's interesting. And you were trying to take us there. We're primarily focused on equities in the first part of this conversation. But I think as we start to think about pivoting to the second part of the conversation, you've got that same concept. Somebody wants to buy something, somebody wants to sell something in lots of other markets. Maybe there's smaller markets than the market cap of an Apple or a Microsoft or an Intel, these huge businesses. But as we look at, they track the market cap of crypto as an example. So maybe that's the next biggest asset class. We're starting to see innovation in art be fractionally traded. We're starting to see fractional trading of real estate. We're starting to see, so fractional trading, I can buy a share of a painting. Masterworks offer this type of service. I own one share in an Apollo 11 joystick via Rally Road. So fractional ownership of collectible items is becoming a thing. Rally Road being a great example of where you can they're providing that market and that exchange type functionality for a collectibles, comics, cars, watches, various different items. So is that the innovation you see coming?
Absolutely. It's exactly where this is going, Stephen. So let's just talk how those work today and why it fails. So a traditional order book, there are multiple different types of orders you can send to an order book. The two critical ones and most basic are called a market order and a limit order. A market order is an order you send that says, hey, whatever the best price you can get to sell or to buy right now, just execute it immediately. And if you do nothing else when you send a trade on Robinhood or Fidelity or whatnot to the market, by default, it's a market order. Hey, I'll take whatever price it is. And that quite literally takes liquidity out of the market. What that means is on the order book, there are a whole bunch of open orders. Hey, I'm willing to sell, or hey, I'm willing to buy. And when you send a market order, you are decreasing the number of orders left on that book. The other critical type of order is a limit order. A limit order is not an order to execute at the best available price. It is an order that says, I'm willing to sell or I'm willing to buy up to this many at this price. So at a buy price, it says, I'm willing to buy at no higher than this price. And if I'm selling, no lower than that price. Those orders might be way what's called out of the market, meaning they may be well away from whatever price is sitting on the other side right now, but they get put on the order book. And as more market orders come in, the price may change. Somebody tries to buy a huge amount of supply. All of a sudden, your limit order that wasn't useful before, all of a sudden it's like, hey, I got to buy up all the supply. All right, I'll buy a little at this price, a little more at the next price, a little more. Hey, now I've tripped your order. So a limit order adds liquidity to the market. The challenge here, Stephen, is, again, that middleman scenario. What happens when there are a bunch of limit orders on the books, but the difference between the lowest buy price and the highest sell price is big? Well, nothing happens. The answer is no trades get done. The market is just stalled. So market makers have step in to bridge that gap temporarily. In small markets, they can't. So oftentimes what you'll see in your shares for a joystick or the watches that you buy, etc., is there's this massive gulf in between the price at which someone will sell and the price at which somebody will buy. And at that point, the market's basically broken. Even though you might see a posted price, hey, this is the price for this thing, it's not real. It's just the middle point between two people that disagree on what the price is supposed to be. Where we're going to get to right now, automated market makers step in and always provide a price. And that is a wild idea.
Your point being, I can list my watch on a market, and people can say they want to buy a watch at a particular price. If that price is so far apart, there's no transaction volume happening.
Correct. And that price, the quote unquote midpoint there, if nobody's transacting, doesn't really give you a lot of information. All it tells you is you found a point in between two people that disagree.
So I think we're on an arc here. Let's keep going. So as we look at some of the, maybe let's take a spin through crypto. That's a smaller market than the equities market. I've lost track of what the total value of crypto market.
What, less than it was yesterday?
Don't get me started. Don't get me started. Bitcoin was $1 billion.
Trillion.
Trillion,
I think is the word you're going for.
Yeah, it's now $1 billion asset class. Yeah, as I say, don't get me started. It was $1 trillion asset class. I think it's in the 700 billion type range with the recent sell-off. Maybe let's start to apply the mechanics of what you're saying to some of those types of markets, and then we'll go, comic books, high-end watches, if you want to indulge me, and we can go there. Maybe let's take those principles into some of those markets, and as we do that, pick up on some of the points you made in the newsletter around some of the innovation that's happening and how this automated market making functionality is starting to sort of step away from people even further and step into how we get liquidity in some of those smaller markets.
So the biggest crypto, the biggest tokens, Stephen, are still big enough that traditional order books, traditional market making, there's nuances to how crypto works and how the exchange works, et cetera. But the basic model of a traditional market maker and a traditional order book work pretty well. That's fundamentally underneath all of the centralized crypto exchanges, the Coinbases of the world. It's the traditional model with nuances for crypto, but it's an order book that matches up and people sit in between as middlemen. As we go out the long tail, we've seen, and we saw this in the original crypto boom, and we see even more now, we have thousands of tokens. I mean, quite literally, thousands of different
14,000 tokens I saw as a number the other week.
Whatever the number is, I believe
it's a crazy
number.
It's
unbelievably large. But the challenge is most of those tokens, we've got two fundamental problems here. One, most of them are teeny. The value of all of those tokens outstanding is 10 million, 20 million, 30 million. Again, it's that too small problem for a traditional market maker. But two, it's not enough to talk about that in isolation. You have to talk about what is the market you're trying to make. I'm trying to trade that token for another token. Now we typically take this for granted in the traditional world because like, oh, what's the price of Apple? Well, what I'm actually saying there is I've got a market that's made up of dollars in Apple stock. Now we could actually make a mess of this if we wanted to. If we wanted to take Apple and Tesla, there's no market for that. There's nobody out there who's making a market to allow me to directly trade Tesla and Apple. But that's actually exactly what we have in the crypto world, because we have Bitcoin, we have Ether, we have all of these kind of base currencies, so to speak. And it's not enough to say I've got this bespoke $20 million currency. Can I just trade it against Ether? I might want to trade it against 3 or 4 or 5 other different things. Even if I could have gotten liquidity, meaning a single market to trade one token against another, as soon as I start saying I want to support trading, pick a token, Matic, against Ether and Uni, and my one market fragments into a whole bunch of smaller markets.
And your point there is it's not 14,000 coins in a trading pair against dollars. It's 14,000 coins in trading pairs against 14,000.
Yeah, that gets to be a big number real fast.
Yeah, and against dollars, and against pounds, and against euros, and depending on which jurisdiction the exchange is operating in, it's the sort of fiat pair, and then the currency, and then the cryptocurrency pair. You know, I recently traded out of some ETH into Solana. That's the mechanics of what's happening. And I can, you know, the top 10 cryptos trading against each other, relatively manageable. Long tail of everything else. A lot of order books with not a lot of liquidity, because how many people are trading, I don't know, Graph against Solana?
Exactly.
You know,
exactly.
Pick a small coin against a small, you know, still one of the big guys. On a daily basis, on an hourly basis, on a per second basis, is there enough volume? So you talked about automated market making in the letter and kind of explained that. Is that really what fundamentally we're talking about here? The ability to trade 2 pairs in a small volume market? Is that really where you're coming from?
Precisely. And if it's actually, if you've heard, for the listeners, if you've heard the term DeFi or decentralized finance, you've heard of a decentralized exchange, what we're about to talk about with automated market makers is at the beating heart of how those work. So let's go into the mechanics first, and then we'll talk about some of the price action a little bit. Again, in a traditional market maker, you've got a firm that acts as the middleman. They buy when people want to sell. They sell when people want to buy. They capture that in between. With an automated market maker, you've got 2 components. First, you have a software program. That software program executes the buy and sell orders. There's no person clicking buttons anymore or whatnot. It's an algorithm. In the blockchain world, we'd call it a smart contract that runs across the whole blockchain. It's distributed, so on and so forth. Underneath that automated market maker, it needs money to go and buy and go to sell. So what you have underneath that is called a liquidity pool. And in that liquidity pool is some of the stuff that they're trying to buy and some of the stuff that they're trying to sell. So if we want to trade apples for bananas, that liquidity pool needs to have both apples and bananas in it. Now, where did those come from? Well, Stephen, from a bunch of people like you and me who go and put apples and bananas into the liquidity pool.
This is I'm staking my bananas into this liquidity pool so they can then be traded and provide that liquidity through to that automated market maker. Is that because a lot of people would have heard the phrase staking, and that's the return, and they'll see that they get a return for that staking.
So we're going to come to that. We're going to come to why would anybody go put their apples and bananas in that pool? The challenge with an automated market maker, there are a couple of them, Stephen. One of the challenges is why, and we'll tackle it first. Why would anybody go and put their apples and bananas in the pool so that the market maker can use it? The answer is the market maker charges a fee on every transaction. So you want to trade 3 apples for 5 bananas, fine. You're also going to pay an additional small fee that gets collected by the automated market maker. It gets paid out pro rata to people that put apples and bananas in the liquidity pool. Pro rata meaning if I put 10% of the value into the pool, I get 10% of the fees back. So that can provide, their drawbacks, that can provide a good incentive to go donate. You earn those transactional revenues. In the traditional world, this would have been the 1.6 billion that Jane Street made in 2020 executing its trades. That's what it captured. This is the equivalent in the automated market maker world.
The key point there, and this is in the name of DeFi and the decentralization, it's a Jane Street as a centralized player in that market. They're taking that 1.7 billion's worth of profit. In a DeFi automated market, that's being split. There's no Jane Street. It's decentralized out to the people who've staked into the liquidity pool.
It's all software, the whole thing, and we can call it smart contracts, we can call it whatever we want. It's just code.
Call it a DAO, call it a smart contract, call it whatever you want to call it. It's a number of decentralized participants providing that function to the market.
Right. So we've got a bunch of people, no idea who they are. They all put their apples and bananas into the liquidity pool. The automated market maker can make trades. So the challenge is, Stephen, what if somebody comes along? What if there are 10 bananas and 10 apples in our pool? What if someone comes along and goes, you know what? I'm going to empty all of the bananas. I'm going to buy all 10. They got to break our model here. So under the covers, there's most of the automated market makers use what's called a constant product market maker. There's other algorithms we can use. The essentials of it, and we can use the constant product because it's the most popular, is that it dynamically adjusts the price in the pool of apples to bananas. What do I mean by that? So if I've got 10 apples and 10 bananas, 1 apple is worth 1 banana. If I try to buy an apple out of that pool, what am I left with? Well, someone's going to pay me with 1 and a little more bananas, because when I get left, I'm going to have 11 plus a little bit bananas and 9 apples. The next apple I try and buy out of that pool is going to be a little more expensive, a little more, a little more. What we're looking at here, when I say dynamically, this is basic 101 supply and demand. As I try and take apples out of that pool, apples get more expensive compared to bananas. As I add them back in, they get cheaper relative to bananas. And the math works such that the last banana or the last apple in the pool is infinitely expensive. So you've actually got an exponential curve here, not linear, exponential, so that as I try and take supply out of the market, the supply of apples or supply of bananas, the pool never actually gets empty. That in itself keeps the liquidity pool continually functioning. But 2, if I take a lot of the apples out of there, the apples in that pool are going to get real expensive. If I can go find somewhere else where I can go buy apples, I now have an arbitrage opportunity. I can buy the cheap apples somewhere else. I can sell them back into the pool and bring that apple price in the pool back to something that's realistic. And that is absolutely critical here because it keeps the liquidity pool. It stops the liquidity pool from ever emptying, and arbitrage keeps the price in the pool relatively on par with what the price for those goods might be elsewhere.
And that's the perfect view of how this works. I think the sort of challenge, and I'll mention it on behalf of the listeners, is I'm a whale with hundreds of millions worth of Apple token in that market that you just described, in the Apple banana sort of liquidity pool. There's some ripe for manipulation if I'm big enough and I'm able to participate and sort of skew that market, because we're talking about small markets here. The total market cap of these tokens and the pair, crucially, of these 2 tokens may be relatively small.
It could be, but we've got a massive innovation. I don't want to overlook this, Stephen. Yes, there are drawbacks, and we could hit on some of the others. There's something called impermanent loss, which I do want to just tip our hat at. But before we wrap on it, where in an order book model, we can have this gap between buyers and sellers and no transactions get done. In an automated market maker, there's always a price at which something can get executed. You might not like the price, but the contract, the software stands ready with capital available at a price to say, look, I'll transact with you. That is wild. That means that you've got this mechanism. And again, the people contributing apples and bananas, the liquidity providers putting them in the pool, get paid fees. So you've got a mechanism that in theory should always be able to be profitable in just about any market, any asset pair. That is a wild innovation that it fundamentally transforms how we think about how can you create liquidity in small markets, whether there's stocks of startups or watches or what have you. That's awesome.
And that's fundamental for me around the transformation that we're talking about with DeFi. There's lots of heat and noise in that market. There's a lot of hype. There's a lot of sort of various discussions. I think for me, that's the crucial component of the innovation that's happening in this space. We're bringing some of the innovation that took decades and centuries even in the traditional equity space. And we're talking about a DeFi market that probably only exists in the last 5 years.
This in the last two. And again, it's a really important point, Stephen. You don't have to care about crypto or any of this stuff. The focus here is we've got a new way of making markets that we've never had before. That has applicability way beyond the crypto stuff we're talking about. That's extraordinary.
Well, we're seeing that innovation happen in the collectibles market. As I say, Rally Road, no endorsement. I've been on the platform for 2 or 3 years now, but they've just bought in enhanced liquidity because they're making markets between two participants. So, we're seeing this innovation happen. You don't have to be a Bitcoin maximalist and invest and see that value to understand what's happening from a finance point of view. And just as we start to wrap, you're seeing that innovation that's happening in the DeFi and crypto space start to be noticed by the traditional runners of markets in the equity space. And you mentioned that in the newsletter.
Correct. Before we wrap, I want to hit on, so we hit on the drawback of traditional market makers. As markets get small, it's difficult for them to be profitable, so they don't make markets in small stuff. The drawback of automated market makers is the tension between that fee that gets charged on the transaction and what's known as impermanent loss, which is the worst named concept in finance. You look at the letter for more details, but just take me at my word for our listeners here. When that liquidity pool gets spun up, 10 apples, 10 bananas, the moment that it moves off that ratio, they're now 13 or 14 bananas in there and 6-ish apples in the pool. If I want to take my liquidity back out of that pool, I get 10% of that pool back. I am taking a loss. That loss is regardless of what direction. If bananas got more expensive or apples got more expensive, it does not matter. If both got more expensive because lots of people added more liquidity to the pool, I take a loss. And that loss can either be real, meaning I put $100 of value in and I got 70 out, or if both got more expensive, I actually would have made more money just holding on to my apples and bananas and not participating in the pool at all. So the point of the fee is, one, incentivize me to put it in, but two, to offset that loss. The challenge is that when the prices are very, very, very volatile, when they move a lot, that loss can get very large, which means you have to charge a higher fee on each transaction to offset the price movement. That is a tension that there's tremendous innovation going on, and probably a topic for another letter, another podcast. But that tension is the fundamental limitation of automated market makers today, When you have two assets in the pool where the prices bounce around a lot, the size of the fee you would have to charge to justify putting liquidity in your apples and bananas, it simply doesn't make sense. Those transactional costs just get prohibitively expensive.
And this is it. Go back to our 20 million market cap equity. This type of innovation can transpose back from the crypto and DeFi space back into the equity space. And I think that's where the interest is cross-pollinating.
So correct. So we'll leave innovation, some truly awesome stuff. I'll give you just one headline. You've got one firm that allows you to put up to 8 assets in a single liquidity pool, and they all balance against each other. How the math works is completely beyond me. Really, really cool innovation there. What we're seeing, though, is we're seeing that kind of traditional market makers, Stephen, wake up and go, my God, there's something happening here. So FTX, now one of the largest crypto exchanges, was actually started by an ex-Jane Street employee. Young guy, he's just 29 now. We have a new innovation happening in the automated market maker space, something called CrocSwap. It is started by a former Citadel employee. Citadel, again, another massive market maker. Jane Street came out like 3-4 days ago and said, yes, actually, we're starting to look at crypto and we're standing up or have stood up a team because we realize there's interesting stuff happening here in how you make markets. Citadel just raised a 1.2 or so billion dollar round, interestingly, from Sequoia and from Paradigm. Paradigm is a crypto-focused venture capital firm, and Citadel has come out and said, yes, we are interested in looking at it. We're trying to understand what we're going to do. There's innovation here happening here that we need to get involved with. So we are watching this market, Stephen, come full circle. The traditional big boy market makers are looking at this and going, my God, there's an entirely new way of making markets, and we need to have a seat at the table.
Well, I think that's a fantastic place for us to wrap. As always, we've failed spectacularly on getting to 30 minutes. We set the objective every week and we fail with, 37 minutes in here. So I'll wrap us up. You've been listening to the Fat Tailed Thoughts podcast. We're trying to grow the show. We're on episode 14. Please click and subscribe if you're on YouTube. Like and rate the podcast if you're on Spotify or Apple. We'll bring you more episodes as we do every week on the makings of money, fintech, and crypto. You've been listening to Jared and I. We'll speak to you next week. Thank you very much.